Very good. Good evening. My name is George Christopoulos, and I'm with a company called MortgageBrokers.com. And I'll be speaking to you tonight about mortgage financing. Briefly, I'll tell you a little bit about my background, and then we're going to cover a wide range of topics for you. Previous to working at MortgageBrokers.com, I was with TD Bank, and then previous to that with Scotiabank. At TD, I was one of their top mortgage people for probably the last 5 or 6 years. And the past year and a half to 2 years, I've joined MortgageBrokers.com and run my own satellite office, and I have about 6 other people who are brokers working with me, junior brokers, if you would. Role of a mortgage broker, and sorry, just to back up a little bit, we are all ex-bankers too, so we know mortgage lending. Our role as brokers is this, to basically get you approved, get you pre-approved, get you organized, and give you an unbiased opinion as to all the different products that are out there. Because we don't work for one specific company, we really aren't aligned to say, look, you've got to go with this people or you got to go with that group. Whatever works for you, whatever the best offer is at that time, not only just the best offer, but the best overall package. And we've got, for example, variable rate mortgages are very popular right now. We have some companies offer 5-year variable rate mortgages, others offer 3, others offer a new 1-year variable rate mortgage. Not all. One company does not offer all 3 of those, but there is a strategy involved. And when we do our buyer planning session with you, our mortgage planning session, I should say, we'll go through the different strategies. So just simply taking variable rate mortgage is not that simple, and we'd like to be one step ahead of the game and also having you plan your next move in terms of what's happening in the mortgage marketplace down the road. So tonight we'll be talking about how to do a proper pre-approval, using your RSPs, selecting the right mortgage for yourself, and then finally how to pay off your mortgage. So let's start with the pre-approval. Now, we like to use a term called full pre-approval, and we compare this to what we call a quick qualifier. And a quick qualifier is something that you might do online or pick up the phone and call someone and say, here's how much money I earn, what is your interest rate, what can I afford? Well, that's the most basic of information you can get from a mortgage specialist or broker. A full pre-approval in our eyes is the best way to do this. And basically it's sitting with you, getting to know more about you, not just how much money you earn, but how do you earn it? How does it come to you throughout the year? Also, how much of a down payment you have, or what are you comfortable with? What are you comfortable with on your monthly payments? How are you employed? And then bring all the paperwork that goes along with it. And we break it down into 3 areas: your income, your down payment, and your credit history. These 3 areas, you will have to cover this before you be approved for a mortgage anywhere. The only thing you can't do in advance is us to attach a property to this, and that's where your realtor comes in and they do a wonderful job with that. So we can prepare 3 out of the 4 things you will need to do to be approved for a mortgage at some point. So you're way ahead of the game by doing this. So let's start with your income. Your income is basically broken down into one of 2 ways. You either have a guaranteed amount of income or you do not. If you have a guaranteed amount of income, you could typically be on salary or an hourly wage. So hourly wage could say 40 hours a week, $20 an hour, that's your base income. And if you have a salary, say of $50,000, that is your income there, and that's where we begin. So as long as you've passed probation, and in Ontario, your probation is a 3-month period, and even if it's not mentioned in any new job offer, it is still there. Under provincial guidelines, your employer doesn't even have to make you aware of it. It is there, and they can fall back on it. So it's something that we will ask you if you're at a brand new job. So we start with your gross income, and we can take into consideration other income, but it has to be documented. So other income would be typically bonuses, commissions, overtime, part-time, for example, and we can use these monies in your calculations. But there's a catch here. We must have a 2-year history of this. And a 2-year history is important because what it shows the bank is that there's consistency in the money that you're earning. And that's very important. And you'll find that the Canadian banking system, there's a lot of checks and measures. 5 years ago, we were considered very, very conservative. Now, we're the envy of the world because we actually knew what we were doing. So it's a good thing that there are checks and measures, because everything's great when, the market's really hot and, property prices going up. But if the market changes in any way, like we did last year, we had a little bit of a downturn, economic downturn. Basically, we want to make sure that our customers that have borrowed money are not going to be in a position where they're going to fail. And that's what happened in the States. Really, the banks in the States set up the consumer for failure because of the way they were underwriting. It was very, very, how would you put it, irresponsible on their part for what happened in the States. That could have totally been avoided. But in Canada, that will not happen because we have checks and measures that we are in place, and we do not allow that to get to that point. Now, the other side of the coin is people that don't have a guaranteed amount of income. And this could be someone that would be on contract, 100% commission, self-employed, investment income, rental income, anything that you cannot look at where you're going to be a year from now and say, I will have earned this much money minimum. Now, in this type of scenario, we typically classify you as being self-employed. And we're going to ask you to provide us your tax returns first off. Now, we're going to start there, and anyone that falls into that category immediately is thinking, there's no way, because if you're a self-employed person, you're doing that for a reason. And the reason is that you want to write off your expenses and pay less tax. Great thing to be doing. So basically your income is up here, but by the time the government, but you pay your taxes, you're way down here in terms of what you're showing, right? So we have to start somewhere though. So we're looking for two things. How much income are you declaring, and are your taxes up to date? Two very important things. We'll play with the figures a little bit, and if what you show as income does not quite get you to where you want to be, then we do have other specialty programs. And these are programs for people that are self-employed, and you must be self-employed for 2 years and show us documentation, maybe a business license or articles of incorporation or a GST return or something. And if you have a good credit score, and let's say you only declare $15,000 a year in income, but you wish to purchase a $350,000 home with 5 or 10% down, it can be done. The interest rate is the same. The only thing that differs is that the CMHC premium is higher. So that's why we ask you to give us your notice of assessments first to see what we're dealing with. So if we can save you money on the CMHC premium, we'll steer you in that direction. But if that doesn't work, we do have this other program to fall back on. And that is also the fastest growing market segment out there too. I think the statistics are showing us now that fully 20 to 25% of all the consumers right now fall into the self-declared or self-employed category. So it is a growing part of the demographic. Now, phase 2 of this process now is your down payment. And we need to verify that you have enough money for your down payment plus 1.5% of the purchase price that we deem you will need for closing costs. Now, the 1.5% is a banking underwriting figure that we use. Tom will give you a breakdown a little bit later in terms of your actual closing costs, and it varies depending whether you're buying in the city of Toronto, Mississauga, Markham, if you're a first-time home buyer, if you're a second-time home buyer. So that's why we just bulk it in at 1.5%. Now, we'll ask you to provide us bank statements, GIC statements. If a family member is helping you, we have a formula for that too, and it's called a gift letter. So simply put, your family member would declare that they're giving you the money to be used as a down payment, and that's good enough for the banks. Now, the reason we're fussy here is that, once again, there's checks and measures. We want to make sure that you're not getting yourself into a situation that could implode on you. And oftentimes when well, let me explain to you how a purchase works. When you purchase a home or a condo, you will make a purchase and then you'll provide an initial deposit with that. And then your closing date where you get the key might be 3-4 months later. And that's when you provide the rest of the down payment. And some people say, well, you know what, I've got this much money now and I'm going to save an extra $5,000 or $10,000 in the next 3 months. Well, that's a little ambitious, and sometimes it doesn't happen. And what happens here is that you've entered into a legal contract. And if on the day of closing you do not have enough money to provide the people that are selling the house with and your closing costs, and you choose to try to walk away from the deal, then what will happen is you will be sued. And that's what we want to avoid, that you're not getting in over your head into a position that's going to cause you even more expense and a lot of stress. So we want to make sure that you're all ready to go and you have a very smooth closing. Now, third phase of the process is the most important. This is your credit history. And every credit card, line of credit, student loan, lease that you have, any of your company you're dealing with, every month a report goes out to two major agencies in Canada, Equifax and TransUnion. And the report that goes out states how much was your payment, when was that payment made, and what is the remaining balance on the credit card or lease or what have you. Now, if your payment is made in the allotted time, which is typically 30 days, your rating is what we call R1. R2 would be 31 to 60 days, R3, 61 to 90, and so on and so forth. If all of your ratings right now are at R1, you will be approved for mortgage. It's simply a matter of how much based on your income. If you have an R2 mixed in with a few R1s or an R3 mixed in with a few R1s, it won't affect you too much. Yes?
Both have to have R1, or like two people on the credit history both have to be R1 rated?
Yes, let me finish this because that's just the tip of the iceberg here, and it'll come full circle in just a second, okay? But if everything right now is R3, R4, or 5 or greater, you're not going to be approved for a mortgage because that's affecting what we call your credit score. And this is where all this gets tallied up. Your credit score is an overall rating, and it's a rating of your last 7 years of credit history. And the two things that affect your credit score are repayment of credit on time and balances. Not limits, balances. And the balances in relation to the limit, to be exact. And basically, the figure that we estimate that is a good figure to be below is 80%. So 80% of your limit, if you are constantly below that, your credit score is healthy. Now, if it spikes up for 1 or 2 months, it's not a big deal. And that could typically happen over Christmas, for example, or maybe a summer vacation or a renovation or what have you. And the reason is that your credit score is calculated over a 7-year period. So the two main things that affect your credit score are your debt in relation to your limits and the repayment of credit cards on time. If you've had any bruises or slow payments, maybe you got out of school, after 5 or 6 years of university, decided to whoop it up a little bit and spend some money. Things that's not unusual, and things are a little slow. Not to worry because time does heal these things. So as long as the stuff's been dealt with, and it'll show on your credit bureau if it's still there. It's been with 7 years, so we'll see that. But as time goes on, the effect of it lessens, and your repayment of credit on time will increase your credit score. Now, it's very important because there are minimum requirements for credit scores in Canada. To be approved at a bank, you must have a minimum credit score of 600 points. And to qualify for the programs such as self-employed, you must have even higher. 650, 680, 700 are thresholds depending on the size of your down payment. Also, backing up just a little bit, there is still a zero down payment program out there. Now, it's not the one that was around 2 years ago, but it's a zero down payment program where the bank will either lend you the 5% down payment, or you can borrow the 5% down payment on, say, a line of credit. So if you fall into that category too, then once again, your credit score is very, very important. So very important that we look at your credit at time of pre-approval. The other thing that we want to look at as we're looking at your credit is making sure that there are no errors in your credit bureau. And it's not unusual. Credit bureaus are databases, and databases are often incorrect. And basically, simple things can mix things up. Names, for example, common names, Thomas Cook, or names that can be interchanged, Peter Bernard, Bernard Peters, this type of thing. Every culture has its own Thomas Cooks. It could be very short names, it could be very long names. Also, things that happen are that maybe you paid off a credit card, but the agency that you were dealing with didn't report it to Equifax, and that still shows there. Now, it won't affect your credit score, but oftentimes people get really upset when they say, oh, no, I've paid all that off, but it's still there. So in the process of getting all this done, it's good to have all this organized. Now, how this relates to you in the whole scheme of things is this. If you've waited until the last minute and you haven't seen your credit bureau, had a professional look at your credit bureau, and you've gone out on the weekend and bought, say, a new condo from a builder, or walked into an open house, fell in love with it, and made an offer on it, and now you're fortunate enough to have 3 or 4 days to get your financing in order, what's going to happen is this. Credit check will be done, and if there's a mistake there, then the bank will come back to you and say, we need more information. Because what you're telling us is one thing, and what we're seeing is something totally different. And we'll give you the benefit of the doubt, so you've got a big maybe. Now, by the time you go out and gather more information to take it back to the bank, the 3 or 4 or 5 days that you've had allotted to arrange your financing will have quickly come and gone, because when we send information into a bank, they're not sitting at the fax machine or email waiting for it. It's going to go into queue somewhere, and some administrator is going to get to it eventually, organize it, and it could take a full day for someone to even look at that. And how this affects you is this. At some point in the process, you will have to sign your name on the contract saying, I am proceeding with this. No ifs, ands, or buts, I'm buying this property. And I'm not a big fan of someone signing their name on a $300,000 or $400,000 purchase without an absolute yes from the bank saying, yes, you are approved, your money is there waiting for you. So that is the benefit of preparing and doing your pre-approval in advance. We've got all your information now. Now, sorry, before I move on, if you're not ready to do a pre-approval at this stage, and maybe you're preparing for a year out, or it could be even 2 years out, there's nothing wrong with looking at your own credit history. And you can contact Equifax or TransUnion, or just Google Credit Report Canada. It'll point you to the right direction. They offer many different services. Now, to get all the information that I just gave you, which is the important stuff, you will have to pay about $25. There's a free service, but it is very, very generic. It won't give you the information that you're looking for, because it's just you have to pay for it. Okay, so it's very important. Now, we've got your information now. We know what your credit score is. We know what your debts are. We know what your income is, and we know what your down payment is. And we're going to come up with an overall plan for you. We will tell you 3 different figures of what you can afford. It'll be based on a 25-year, 30 and 35-year amortization. And it's important to know these figures, because you may not take the full 35 years to pay it off, which is a good thing. Pay it off sooner, you save money. But it's good to know for this reason. Maybe your budget is $1,500 a month, and you're out there shopping, and everything you see, when we do the math for you, doesn't quite meet your needs. But if you had to spend an extra $20,000, that meets your needs. And sometimes it's simpler to spend an extra $20,000 now when you're buying real estate than compromising too much and then immediately discovering that what you bought you hate, and then immediately you want to sell and buy again. Selling and buying is much more expensive than buying for the first time. So by knowing what your amortizations are and the extra money, you may be able to go to a 30 or 35-year amortization, spend the extra $20,000, your budget remains the same, so it doesn't affect your monthly budget, and then we will show you how to pay it off gradually so you don't take the full 30 or 35 years. So it's very important that you know these figures to know your complete budget. The reality is, in this economy, and regardless of what you read in the newspapers, most people buy well below what they can afford. So when you hear all this doom and gloom in the papers about, this pending economic crisis because people aren't going to be able to afford their payments, again, they're buying well below what they can afford. As Canadians, we are still conservative, and that's a good thing. That's what's kept our market healthy for the last 10 years. So going forward now. All right, so you know what you can afford. Now's the time that we also talk to you about different types of mortgages. Now, I break it down into basically 2 types of mortgages. We have a short-term mortgage and a long-term mortgage. And I'll go on record as saying right now in today's marketplace, there is no bad choice in terms of a mortgage. Well, there is one bad choice, and what that is taking a 10-year mortgage, because that just does not make sense. It's way too costly in terms of what the interest rates are for taking that long a mortgage. But Canadians typically take a 5-year mortgage. Now, this is where it differs. You can take a 5-year fixed rate mortgage, and that's under 4% right now. And I remember telling people a couple years ago that if you could lock in at 5 or under 5%, do it. Well, now we're under 4%, and the rates are so low. To put this into perspective for you, I bought my first house in 1989, and I paid 13% interest. 2 years later, I renewed at 9%. So the rates are very, very appealing right now. So with the 5-year fixed mortgage, you have a guaranteed interest rate for the next 5 years. The variable rate mortgage now is the classic short-term mortgage. And this is also very, very popular. Now the variable rate is determined every 3 months by the Bank of Canada. And it looks like we are probably going to get about a year or a little bit longer at the level where we are right now. But make no mistakes about this, the variable rate will rise back to historic levels in about 2 to 3 years. And those levels come in at about 5%. At the end of the day, 5 years from now, we'll do the math on it and see what was better. I think you'll find out that there's not going to be a huge difference between the variable rate and the fixed rate in terms of what the cost will be over the next 5 years. The variable rate will probably outperform a little bit better than compared to the fixed rate mortgage, but there's a cost to that too, and the cost is this: nervousness, stress. And if you're a worrisome person and you're constantly thinking about what is the rate going to do, it's not the right mortgage for you, no matter how much you save. My best advice to everyone is, at the end of the night, when you lay your head down, what lets you sleep comfortably? And as I said, if you take a 5-year mortgage at 3.89, 3.79, depending on which company we use, you can't go wrong. You can't go wrong with a variable rate either. So both are good choices. We'll cover that information with you at the time of the mortgage consultation, and then once you buy again, we'll cover it all again, because things do change. We can predict now, but things change 3 months from now, so we want to make sure that you're not making an old decision on information that was old. Okay, so you've got your down payment, you have your budget now. Let's talk about now our RRSPs. Come on. Oh, sorry. I hope I'm not clicking too many here. There we go. Oops. There we go. Okay. You can use your RRSPs to purchase your first home if you are a first-time home buyer. Sorry, it doesn't have to be your first home. As long as you are a first-time home buyer, you can purchase using your RRSPs. To qualify as a first-time home buyer, you must have not owned a home in the past 5 years. And that home has to be your primary residence. So there are some exclusions. So if you had maybe invested in a property but never lived in it, or maybe inherited a property, then that does not eliminate you from being a first-time home buyer. Now, the money comes out tax-free, and once the money comes out of your RRSP tax-free, it is now technically known as a home buyer's plan. Now, before the money can come out of your RRSP, it must be there for 90 days for it to become eligible. All right, so 90 days in the RRSP, then you can take it out tax-free as long as you have made an offer on a property. Now, you do have to put the money back in, and this is done over a 15-year period. Any money withdrawn in 2010, the first repayment of this into your home buyer's plan would be March 1st, 2012. So at this point in time, you've got over 2 years before you have to start putting this money back in. There are no additional fees or service charges. Simply take whatever you withdrew and divide it by 15. And let's use round numbers. You took out $15,000. Every year, you're going to have to put back $1,000 into your home buyer's plan. Where you declare this is on your income tax for that year. Now, my advice to you here is that take the full 15 years to put the money back in. There is no benefit in putting the money back in sooner. If you put the money back in sooner, then basically you're missing a tax break here, and it's this. The $1,000, let's say you've got $2,000 available to put back into RSPs the following year. So you take the $1,000, put that into your home buyer's plan, no tax refund. You already received that 2 or 3 years ago. But you still want to build up your RSPs. So take an extra $1,000, buy a completely new RRSP, separate from that home buyer's plan. You will receive a tax refund on that extra $1,000. So now you're doing two things here. You're building back your RSPs, and you're taking advantage of as much tax refunds as you can possibly do. So there is no benefit in putting it back sooner. Alternatively, Revenue Canada does not let you skip a year. So if you can't make that payment for $1,000, what they will do is take that $1,000 payment and add it back to your income. So if you made $50,000 a year in income, you will now pay income tax on $51,000. Once again, not the worst thing that can happen, because what you're doing here is simply giving back the tax refund that you received 2 or 3 years earlier. All right. Benefits of this: you can use it for your down payment, closing costs, renovations, paying off debt. The most creative one we've done in the past few years, and this was a couple years back when we had the true zero down payment. We had a client that had gone back to school to do his MBA and ran up some debt. His wife was still working, and then what we did is we maxed out their RSPs, created tax refunds for them, used the tax refunds to pay off the loans, the debts that they had, and then withdrew the RSP money and paid back the RSP loans. So they had zero money, but they had zero debt, and they bought with zero down payment. And that worked fine because it cleared up everything. So there are a lot of things that we can do for you here. It's a perfect time of year to be thinking about if you're planning on buying in the future, or especially if you're buying in 2010, because RSP deadline is coming up the end of February. Now, we do run a couple courses on Saturday mornings, I think, John, right? Saturday? Yeah, Saturday mornings. So we will show you how to maximize your RRSPs. We will actually create for you a personalized spreadsheet. Now, you will have to give us a little bit of personal information, but by the time you leave there, we will show you how to maximize your RSPs for cash. Okay? Now, I'll give you a couple of examples. Let's say you've got $10,000 in cash, $10,000 in your RSPs, and you're planning on buying this spring. Well, you take the $10,000 that you have in cash, throw it into your RSP, and you'll generate a tax refund for yourself of maybe $3,500. So come April or May, when you're ready to buy, instead of having $20,000, you now have $23,500 because of your tax refund. All right? Other ways we can do it is start taking RSP loans. We can take an RSP loan, say $10,000, $20,000. That'll create a tax refund for you. If you take $20,000, it could create a tax refund of $7,000. You'll make payments on that loan as time goes on, but let's say you pay it off in 6 months. Sorry, let's say you withdraw in 6 months. You may have paid off maybe another $2,000. You take the RSP that you bought, pay off the RSP loan. You've got your tax refund plus any money that you've paid off on the loan. So there are a lot of creative ways that we can work with you here. And if you're thinking about it, it's a very good session to take. It's only about 45 minutes. All right? So, any questions on your RSPs? Okay, so lastly then, let's cover how to pay off your mortgage. Now, there are a lot of mortgage options out there, payment options that is, weekly, bi-weekly, accelerated bi-weeklies. If you want to pay off your mortgage quicker, the two words that you're looking for are rapid or accelerated. And these would be both weeklies or bi-weeklies. Now, these are the ones that create an extra payment for you over the course of the year and help you pay off your mortgage quicker. On an accelerated bi-weekly payment, on a 25-year amortization, you will lower your amortization to about 21 years. Visualize now you had a $1,000 a month payment, 4 years, 48 months, $48,000 in interest savings simply by doing an accelerated bi-weekly payment. All the banks and trust companies offer you what we call prepayment options, and this allows you to pay extra money towards your mortgage. And there are two basic features here. They are what we call lump sum payments, and that is a percentage of the original balance of the mortgage, and that could range anywhere from 10% to 25% a year. So if you had a $200,000 mortgage, say a 20% prepayment, you could put an extra $40,000 a year towards that at no penalty. You can also take your payment and increase it in the same manner. And Tom has a formula that he will show you at the end of the evening, and he will show you how to pay off your mortgage in 10 years without making any lump sum payments, simply by increasing your payment amount and doing bi-weekly payments. Now, I think there was a question earlier about the cost of interest and what have you. Your interest, when we show you an amortization schedule, and I think Tom may have one in the booklet there, that is a forecast of what you would pay if you don't do anything. You only pay interest on what you owe. So if you're able to pay, the example I used, if you're able to pay an extra $40,000 towards your mortgage, the next payment that comes out, there will be the $40,000 that was there. There's no interest on that, but now because you've only paid it. So let's go back to the example of $1,000 a month. You have a $1,000 a month payment, And in the first year, you're able to pay, let's say, $2,000 extra towards that mortgage. The next payment that comes out, the payment doesn't change. It's that way. It's minimum payment for, say, 5 years, right? But you've paid an extra $2,000. So now, instead of the interest being, say, $800, now maybe it's $750. That extra $50 goes to lowering the balance. And you now don't pay interest on that $2,000 over the next 20 years, which is tens of thousands of dollars in savings. So simply put, you only pay interest on what you owe. And the simplest way to do this is find a budget that works for you. It could be an extra $50 a month. It could be an extra $100 a month. And that's the easier way to do it, because trying to save money to throw large chunks of money at your mortgage is difficult to do. We always come up with some sort of expense or something, you know? Yes?
I have one question. Let's say, for example, you are allowed to pay 15% of your mortgage.
Right.
I think it is every year.
Correct.
But 15% of the whole mortgage, I can put every year.
Of the original balance.
Okay. And if can I pay it at the end of the year, or I have to pay it bi-weekly? Or
No, you can do that anytime. So you have three features, and one doesn't cancel the other. You have your biweekly payments. That doesn't change. And now let's say you have an extra $3,000. You don't have to wait till the end of the 1 year to do it.
I can
At any time.
immediately do that.
It's 15% total over the year, or 20%, depending on what company we use, right? And do it sooner than later, because if you pay it in January as opposed to September, now you've paid interest on $1,500 less for 8 months. Right. Okay. You got a question, sir? Or?
Yeah, I was going to ask you, can you pay the whole balance off after 5 years, or is there, do banks allow that?
At the end of 5 years, you can do whatever you want. Yeah. At the end of 5 years, you can pay it off completely. No penalty. Also, within that 5-year period, the mortgages are what we call portable. So simply put, if you sell this property that you're in right now and you move to another property, you can transfer the mortgage to the other property without any penalties. So you can move it around. So you don't have to stay in that house for 5 years. You can move around and take the mortgage with you. Okay? Question? Yes.
Sort of a similar question. If you have somebody that's locked in and you think you'll be able to pay over and above the 15%, does it make sense to negotiate a 1 or 2 year mortgage rather than a 5-year mortgage?
Absolutely.
Pay it
Yeah.
off.
Tell us, we like to think a few years ahead. And if you have a situation where you know there's a big change coming in your life, let us know that. We would be doing you a disservice putting you to a 5-year mortgage when you know that maybe 2 years from now, maybe you've got a trust or an inheritance or something coming your way that maybe $100,000 or $50,000 that would put a dramatic change in your lifestyle. Let us know that, and we'll customize something for you. Okay? Any other questions on that? Okay, so I'll leave you with that then. So basically, my information is in there in the packages. If you have very, very personal information, call me, or send me an email. As I said, we deal with many, many different companies, and we'll provide you really, really good rates, and more so than that, proper information. And the rates, I don't put too much emphasis on the rates. You can shop that on the internet. I just want to assure you that you'll get great rates, but also we'll get you great service and make sure that you're properly set up. And as I said, think a few years out so you're not getting into the wrong mortgage.